Andrew Holland, CEO at Ambit Investment Advisors, joins us right now on the show. Andrew, hi, morning. The last time we were chatting, you were talking about as to how the market seemed to be overplaying the Modi rally. How have you read into the consolidation / profit taking the last couple of trading sessions? Does it seem like this could continue till 16th May?
I think after the next set of round of voting, we might start to hear some of what's happening on the ground and what people have been thinking. So you might still yet have another rally, ahead of the kind of exit polls on the 12th and 13th. Yeah, so I think that's probably what's going to happen. I'm trying not to think too short term in terms of the next few weeks. I'd rather wait for the event to come over and then decide what needs to be done. But yeah, I think you could have some speculation that things are either looking better or not as good. Probably from the back end of next week as we go into the weekend.
Andrew, historically we know that markets, they always tend to discount the event way ahead of the actual occurrence. So at 6,800 on the Nifty, how much of the good news is already in the price? Is a stable price, is a stable government already in the price now?
I think to that extent it is, Nikunj, but let's say it's a stable government, and whoever that stable government is, sets out the next 100 days of the policy going forward, along with a budget which will be more realistic than the last one. The market could then move ahead on the basis that India Inc. will be feeling more confident about India. So will foreign investors. So will foreign direct investors. And that will be all the momentum India needs, to get the GDP growth getting towards 5.5% and 7% the year after, and the earnings explosion from there because of the operational gearing for India is immense. So I think that will keep the markets continuing to move high. And as I've said before, that we believe that we've entered a bull market, and I see a similar pattern to 2003 to 2006 in both GDP and earnings growth.
Andrew, I guess the central question for an investor or for a trader is that how much of the mean revision in cyclicals is over? 3 months ago, cyclicals were cheap, but after an average 40-50% appreciation in cyclicals, none of the cyclical stocks are cheap. Do you think now easy money in cyclical has been made?
No, I don't actually. I don't think that's the case at all. I mean, obviously in the very short term, you could see that they might consolidate or even slightly fall from here, but that's just a good opportunity. I think you have to fast forward, Nikunj, to where we're going to be in 2 years in the economy, and whether the capex cycle has picked up or not, and the order books of these companies will be a lot different than they are today. So I don't think you can look at the valuations today and really say that they're overvalued. We think it's a good 2-year view that we're taking on cyclical, so we'll continue to buy. It's the only story I think for India going forward is a cyclical bet, and we've moved away, as you know, from defensives over the last 6 months anyway, apart from selective IT. So we'll continue to search out for more stocks in these sectors, but it's up about 30-40% as you said, but I think that's part of a longer term run that we're going to see over the next 2 years.
And Andrew, the last time we spoke, you were not quite enthused by the valuations that the pharma pack was as such quoting at, and you talked about them looking a little bit stretched right now. What's the sense with this recent M&A wave, both domestically as well as globally, that we are seeing in the pharma pack, coming out a bit?
Yeah, I mean, we've been looking at that and see if there's anything for Indian companies there, but we don't see any. I mean, apart from obviously the listed companies of the multinationals, we don't see it really having a big impact on the domestic Indian pharmaceutical companies. So we're still of the view that we'd rather switch from pharmaceuticals into cyclicals, which we've been continuing to do. So, you might get relative performance in the very short term, but we think the big gains are going going to be made in cyclicals over the next 2 years, and that's panning out if you look at what's happening in consumer goods as well. I'm certainly not going to pay 40 times for earnings growth of 11%. It just doesn't work. So I think as we move forward, as a new government comes in and hopefully it's stable, then you'll continue to see this switch towards cyclicals.
Andrew, but if I take the clock back, about 3 months ago, the bent of your portfolio was that, look, I would focus only on quality. So do I smell a change?
No, Nikunj, in October we made the switch. We made the call that we would move out of defensives towards cyclicals, and that's exactly what we've been doing. You go through stages of when you want to buy them, where the valuations are, and which sectors are going to be the sectors you want to move into first. So, for example, if you remember, we talked about Barrett Forge on many occasions, basically on the operational gearing of the company, given what was happening in the US and Europe in terms of the pickup there in the auto sector, and that played out very well. The earnings grew by 40-odd%. So the operational gearing in India is a theme that we're playing, and that obviously plays through in cyclical. So we've been moving around in terms of the stocks we've been buying, whether it's in industrials, utilities, auto components, or metals.
Andrew, so within the cyclical space, or I would say the economy space, what are your top ideas? How are you allocating capital? Where are you confident of a 40-50% appreciation, let's say next 12 to 18 months?
So it's split between, power, utilities. I mean, when I say utilities, power and capital goods companies, auto components, and metals. These are the 4 sectors we're concentrating on. Obviously, the larger companies go in your portfolio first, and then you start looking down at some of the larger mid-caps to see if there's any value there, given your views on where you think the capex cycle might go, and which companies would benefit from that. So that's how we're looking at the portfolio. That's how we're positioning it. Doesn't take away the fact that we like, selectively we like the Tech Mahindras in IT. Still, we like the Sun Farmers in pharma, but it's very selective in the defensive sectors. And in terms of the consumer goods, there's no company at the moment which we're really favouring because of the high valuations and the prospects of really kind of a difficult margin outlook. And if El Nino takes place, then obviously there's going to be further pressure on the margins of these companies.
Andrew, you've not owned any banks purely on account of the fundamental concerns with the asset quality, etc. Has that view changed now? Are you at all nibbling into the sector?
No, banks remain. We will rent them on the market rises, but we don't really want to own them yet. It's not where we want to be in the cycle. We think there's better place in terms of the sectors I've mentioned than banks at the moment. We still think there's some underlying problems there still to play out, and it's going to take a lot of time and capital raising by banks to get through these problems. So there could be a lot of dilution going forward. Certainly if the banks don't capitalise on the high prices that they have at the moment, they should do.
So Andrew, you prompted me for my next question. I want to understand that why are you avoiding banks? If you're bullish on the Indian economy, and if you are of the view that Indian economy will bounce back, banks should be the first port of call, because banks is always considered to be the proxy for any economy.
Yeah, so let's think about that. If you think about what happened in the developed markets, I don't think it's been the financial sectors which have been leading the recovery, even though the GDP growth is starting to move ahead in both the US and Europe now. So that's the first thing to say. Secondly, is that the problems within the banking sector aren't going to go away overnight. There's still huge amounts of restructured loans which are being hidden, and we all know this. And it's not going to be an earnings story for the banks. I don't think it's going to be more of a capex cycle like we're looking at, which will be more favourable towards cyclicals at the beginning. Banks, I agree, will come at some stage, but I'll rent the stocks. I don't need to own them, and that's the strategy we'll have for banks.
But Andrew, what is the sense that you're getting about this, mid-cap rally that one has been seeing? Even right now when the tide is turned for the frontliners, mid-caps are holding out. The likes of the Adani twins, or for that matter, a couple of these agri-related themes as well are playing out very well. Anything that you're liking?
As I said, within the four sectors that we're looking at, we have started to look down at some of the mid-caps, the larger mid-caps, should I say, which we think will benefit from the recovery in the economy. But again, you have to always be very selective. I mean, management in these companies you have to look at and be careful with in terms of how they play their own stock. So it does limit your universe of companies, but we're continuing to look through and find these companies. But you've got to take a 2-year view with them, and obviously that locks in your capital for quite a bit. So we're keeping with the large caps by and large, but looking down now at some of the larger mid caps where we can see some value.